You might want to sit down for this, because what guess quietly happening right now in the global gold market could change the way we think about safe haven assets for years. Most people are missing it because there is no loud news alert or dramatic price jump to grab headlines, but if you're watching closely, you'll see a shift so subtle yet powerful that it could signal a turning point. This quarter, central banks around the world are quietly recalibrating their gold positions in ways that have not been seen in recent memory. And Macro Signal has been tracking the data, so you done a T have to guess what S really going on behind closed doors. If you've ever wondered why gold seems to move independently of conventional market panic or hype, this is the exact moment that explains it. Before we dive deeper, make sure to hit that like button and subscribe. Because Macro Signal is bringing you the inside story on trends the mainstream media doesn't even notice. By staying connected, you're giving yourself a front row seat to the moves that actually matter. All right, now back to gold. This quarter's buying patterns are unique because they're not just about increasing reserves. It's about timing, allocation, and in some cases, strategic positioning ahead of potential economic shifts that most investors can't yet see. Some central banks are taking a more aggressive stance, quietly snapping up physical gold, while others are recalculating their exposure in ways that, if noticed too late, could leave many surprised. Here is what makes this different from past quarters. The pace of accumulation isn't always reflected in market prices immediately. You might be watching charts and seeing small incremental changes or even flat prices, but behind the scenes, central banks are accumulating millions of ounces in a way that doesn't create panic but steadily strengthens their balance sheets. Think about it. This is not about short-term speculation or responding to sudden crises. This is a slow, deliberate reshaping of holdings that, when looked back upon, will feel like a pivot point in history. Macro Signal has noticed that some of the largest moves are coming from regions that traditionally have deep data. Now, let's break down the numbers because they tell a story no headline will. According to the latest data, some central banks increased their gold reserves by percentages that might seem small on paper, but in absolute terms, these are hundreds of tons of physical gold quietly entering vaults around the world. This isn't about chasing price spikes, it's about fortifying financial security. And that's why watching these trends gives you an edge. Macro Signal has been tracking which countries are moving the fastest, and the pattern is fascinating. A mix of traditional buyers like the big European economies and unexpected players in Asia and the Middle East are quietly increasing allocations. What's particularly striking this quarter is the speed of adjustment. In previous cycles, central banks would spread purchases over months or even a year, allowing markets to absorb each move gradually. This time, there was evidence that some banks are accelerating acquisitions in a way that signals confidence in gold's role as a long-term hedge. Physical demand is climbing even as prices remain surprisingly steady. It is a classic signal that Macro Signal has seen before. When accumulation happens under the radar, it often precedes a market revaluation that can catch even sophisticated investors off guard. And it's not just the pace, it's also the context. Global economic tensions, from rising inflation to geopolitical uncertainty, are creating a backdrop where gold is no longer just a defensive asset. It's becoming a strategic tool for nations to protect currency reserves, manage risk, and prepare for potential financial turbulence. In fact, some central banks are adjusting their portfolios to reduce exposure to US dollars while increasing gold holdings. This shift might not make headlines today, but it is the kind of move that can reshape financial dynamics months or even years down the line. Macro Signal has identified these subtle trends early, so you understand what's really happening before it becomes obvious. Another important detail is that this quarter's accumulation isn't uniform. Some countries are buying physical gold almost exclusively, focusing on bullion and coins that can be stored safely in domestic vaults. Others are using a combination of gold-backed securities and swaps, strategically balancing liquidity and ownership. The mix of these approaches shows that central banks are thinking carefully about timing, risk, and the impact on global markets. This is why watching just the price charts won't tell the full story. The real action is happening in vaults, balance sheets, and allocation strategies. And here's where the story gets even more interesting. Despite all this quiet accumulation, market prices are not yet reflecting the full scale of buying. Investors watching typical price movements might feel there's nothing happening. But now here's where things get even more strategic. Central banks aren't just buying gold to sit on it. They're actively thinking about timing, positioning, and global leverage. Some of these purchases are clearly hedges against potential dollar weakness, while others are positioning for economic shocks that could unfold over the next few months. The fascinating part is that these moves are being coordinated across regions in subtle ways that the public rarely sees. It's not conspiracy, it's strategy. Macro Signal has been analyzing patterns that indicate certain nations are quietly increasing reserves in anticipation of shifts in currency markets, inflation trends, and geopolitical tensions. One of the most important signals this quarter is the balance between physical gold purchases and digital or paper gold instruments. While physical gold accumulation is tangible and secure, some banks are supplementing with gold-backed securities, ETFs, or swaps to maintain flexibility. This dual strategy allows them to react quickly to market changes without creating sudden price spikes. Observing this, macro signal viewers gain insight into not just what is being bought, but how it's being integrated into broader financial strategies. The way gold is accumulated can be as telling as the amount itself, revealing priorities, risk appetite, and market expectations. Let's talk about timing. In the past, gold buying surges were reactive, triggered by crises, market crashes, or sudden spikes in inflation. Now what we're seeing now is proactive. Central banks are building positions slowly, deliberately, and quietly. The impact is that while the general public sees stable prices, behind the scenes, global reserves are shifting in ways that could reshape the balance of financial power. Macro signal has tracked historical trends, and these types of quiet accumulation periods often precede major price adjustments that catch most investors off guard. Those who understand the signals early, however, are in a position to navigate these shifts with advantage. Another subtle but critical factor is geopolitical context. Some regions are accelerating gold purchases due to increasing uncertainty over trade agreements, sanctions, or currency volatility. Others are hedging against potential inflation spikes or fiscal instability in their domestic economies. These decisions might seem isolated, but when aggregated globally, they create a picture of growing confidence in gold as a reserve asset and caution toward fiat currencies. Macro signal tracks these nuanced moves to help viewers connect the dots between raw numbers and strategic intent. And here, it's something you might not realize, even small quarterly increases by large central banks can have outsized effects. Think about it. Adding a few hundred tons to global reserves quietly strengthens balance sheets without causing panic. But it sends signals to institutional investors, hedge funds, and sovereign wealth managers. The ripple effect is slow but powerful, reshaping perception, strategy, and ultimately... Now, let's zoom in on the broader implications, because this is where the story gets really fascinating. When central banks quietly buy gold, it's not just about hedging against inflation or currency risk. It is about signaling confidence in the long-term stability of gold as a cornerstone of global reserves. Unlike short-term traders reacting to market noise, these institutions are making decisions that will echo for years. Macro signal has been analyzing patterns, showing that this quarter, accumulation is happening at a pace and scale that hasn't been seen for nearly a decade, and it's shaping how we should think about gold's role in global finance. One of the subtle but critical elements is the way central banks are balancing secrecy with strategy. Most of their purchases are done quietly, avoiding headline-grabbing announcements. This ensures markets absorb the moves slowly, preventing sudden price surges that could backfire. For viewers, this means the charts alone don't tell the full story. Physical demand is rising even as spot prices remain steady, which is one of the clearest signals macro signal tracks. This invisible accumulation is a pattern that often precedes a period of significant revaluation, meaning those who understand it early are in a better position to act strategically. Timing and coordination are also key. Some central banks are accelerating purchases in anticipation of upcoming economic data or potential policy changes in major economies. Others are adjusting gold holdings as a hedge against rising debt levels and fiscal uncertainty. These moves are deliberate and calculated, a far cry from the reactive buying during previous market crises. By examining who is buying how much and in what form, macro signal provides insights into the underlying strategies that most investors will completely miss. This type of insight can change how you view not just gold, but the broader stability of financial systems around the world. Another important layer is the regional shift in gold accumulation. Traditionally, Europe and North America were the dominant players, but in recent years, Asia, the Middle East, and parts of Latin America have become major contributors to gold demand. This quarter's data reinforces that trend, showing a significant increase in buying by countries that are not traditionally headline makers. The result is a more diversified, geographically balanced accumulation pattern. Macro signal has identified this as a key factor in understanding why gold prices may stay calm on the surface, even as reserves increase significantly. And let's not forget the psychological impact. While these moves are quiet and methodical, they also send subtle messages to the markets. Hedge funds, institutional investors, and even individual traders pay attention to central bank behavior. A slight uptick in reserves can signal caution, confidence, or strategic positioning. Over time, these signals compound, influencing perception and eventually price action. By following macro signal, you are able to see the forest for the trees, understanding the bigger picture beyond the short-term fluctuations that dominate headlines. Finally, one of the most fascinating aspects of this quarter's data is the consistency across different regions. Despite differing economic pressures, geopolitical challenges, and policy, as we bring this all together, it becomes clear that this quarter S central bank gold buying is more than just numbers on a balance sheet. It's a story of strategy, foresight, and preparation for what could come next. The quiet accumulation we're seeing isn't reactive, it's proactive. Central banks are positioning themselves for potential currency shifts, economic instability, and geopolitical uncertainty, all while the market at large remains focused on short-term headlines. For anyone paying attention, the message is clear. Gold is not just a commodity, it's a strategic asset that continues to grow in importance globally. Macro Signal has been tracking these subtle trends so that our viewers can understand the full picture before the rest of the world catches on. One of the most intriguing parts of this story is the way timing interacts with market psychology. Even small incremental purchases, when repeated consistently, can alter the perception of value over time. Investors who notice these patterns early gain insight into future price movements, while those relying purely on charts and headlines are often left guessing. This quiet recalibration of global reserves signals confidence in gold's role as a hedge against volatility, and understanding it can give you a strategic edge. Macro Signal highlights these insights so that you can see the story beneath the surface, not just the immediate price movements. It's also worth emphasizing how global coordination, whether intentional or coincidental, is shaping market expectations. Countries across Europe, Asia, and the Middle East are all increasing holdings in a way that subtly reinforces gold's stability and credibility. These actions create a ripple effect. Institutional investors, hedge funds, and even smaller investors begin to perceive gold as a stronger safe haven asset, further influencing market dynamics. By following these trends, you're not just watching numbers move, you're watching the future of global financial strategy unfold. And now, as we look ahead, the implications become even more compelling. If this quiet accumulation continues, it's likely that gold's role as a cornerstone of reserves will strengthen, potentially impacting currencies, bond markets, and even commodity pricing in ways that are not immediately obvious. Central banks are taking deliberate steps to hedge against uncertainty, and those steps are shaping the market from the inside out. Understanding this gives you perspective beyond short-term speculation, allowing for smarter decisions and more informed strategies. Macro Signal continues to track these patterns so that you can stay ahead of the curve. Finally, we want to hear from you.